All right. Hello, everyone. I am Caitlin Moore. I'm the Financial Literacy Manager here at UBT, and my job is to talk on financial basics. So today we're going to be talking about preparing to buy a home. So this is not a webinar about buying a home. It's really what you should be doing a couple years prior to the purchase of a home. So we're going to talk through some things, and we're also going to talk through some of the loan types, so you can get familiar with those. This is not an all-encompassing information webinar. So if you are looking to buy a home, please reach out to a loan officer, either at UBT or shop around. We've got some really great ones here at UBT that can help just inform you, even if it's a year or two out from buying a home. But let's get started. All right, so how do I prepare to buy a home? There's a lot of things, and I get these questions a lot. My husband is actually in mortgage lending also. And so not only did I kind of know this stuff just because of him, but even as a home buyer myself, just what should you do 1 year, 2 years out from fulfilling the dream of buying a home? So we're going to start out with 2 years prior to buying a home. What should you be doing? Well, first of all, monitoring your credit score is a huge one. So start paying off any collections or items that are in debt. You can pull your credit score once a year for free from one of the 3 major credit bureaus, Equifax, TransUnion, and Experian. You can request a hard copy, a hard pull. It's for free, and it could be pretty thick if you look at it, but it'll give you everything that's on your credit report, everything that's been reported, whether it's late payments, or there could be fraud. So it's a really good time 2 years out to take care of business. So look at your credit report, see if there's anything that is wrong on there. My husband had an experience where there was a bunch of credit on his report that wasn't his. The funny thing is there was payments made on time. It actually really helped, but it wasn't his. And come to find out, there was a similar name and a similar social security number that had just attached to his credit report. And so we called and he got that cleared off. It was not a big issue, but there was thousands of dollars of credit reported on his credit report, which was not his. So this is the time to look at it a couple of years out, because if there is collections items or debt that you want to clear off of there, it does take a couple months, possibly 6 months or more, to get it off your credit report. Collections items, it's very normal to pull your credit report and find out there's collections. Sometimes doctor's offices, if you move and you don't get back to them about your address change, they just send your stuff straight to collections. So it's very, very possible and kind of the norm anymore that there might be a small collections charge on your credit report that you wouldn't know of otherwise. So it's a really good thing. Get collections off. Collections actually clears off your credit report pretty quickly if you can get it paid in full. So that's nice to know too. All payments should be paid on time every time. So this is a good time to start making all of your payments, whether anything that's reported to your credit report, get those paid on time. Usually places like credit cards, they have a grace period of 10 days. Even if you do have a mortgage, there's usually a grace period before they report it to the credit bureau, but it's really, really important to make sure things are paid on time, because that is reported and you do lose points on your credit score, your overall credit score, when things are not paid on time. Even if it's a one-time late fee or charge, it will get reported to your credit report. And when a lender is pulling your credit score and your credit report to approve you for a loan, they will look at that, because it becomes a liability to the bank to give a loan if you're constantly late on payments. So they don't look at that as a positive, they look at it as a negative. So it's definitely, if you're used to paying things late, now is a good time, even 2 years out, to start paying things on time and start building up a positive credit report from this point out. Don't make any unnecessary credit purchases. I know it seems pretty far out, but a lot of times when we have credit, say we have credit cards, a home loan, or a car loan, things like that, when it's reported on our credit, we already have money used with that credit. So if we could just work on paying that off, it will build up our credit score even higher, and it looks really good on your credit report too. Unnecessary credit purchases would be like taking out new credit cards, taking out new car loans, anything that's going to be reported. If you can avoid taking out new anything and just focus on the stuff that you have, it will reflect better. Get on a budget and start saving for a down payment. 2 years before, you probably have a general idea of what you can afford, and we'll get to kind of what that looks like even 1 year out. So if you know what you can afford, there's a lot of calculators online that can help you kind of look at an estimated cost of your mortgage and a down payment. And we are going to go through the home loans, the type of home loans that, and I specify what you would need for a down payment, but start saving for that. Start saving for it now, even 2 years out. You'll have less to save on a monthly basis the longer you're saving. So it would be a good time to get on a good budget, make sure your payments are on time, and put a little bit away each month for your down payment. And steady work is really, really important. Do not take any gaps in employment if you change jobs. So this is suggesting that if you plan on changing jobs, get the new job first and go right into it rather than quitting and then looking for a job if you can help it. I know that this is 2020 right now. We're coming to a close in this year, which is very exciting. But if we can avoid gaps in employment, most lenders look at the last 2 years of employment. If you have any gaps, they're going to want to know why, and there might be some extra things that you have to do to qualify for the loan. If you have a job that you get bonuses from on a consistent basis, be really cautious. They oftentimes will, let me preface by saying, if you're going to use those bonuses in your budget to say, I can afford this because I get these bonuses, most lenders want to see 2 years of consistent bonuses and they'll average that out. So if you don't want to just use a base pay, some people get a base pay plus incentives, but you want your incentives to apply, you'll need 2 years of that in most cases for any lender to give you a home loan, because they want to see that. Now you can get incentives and just say, I want to get pre-approved based off of my base salary, and that's fine. But the incentives, usually they want 2 years. So that's why steady work is really important. And no gaps in employment is really important, especially if you have an incentive type of job. And then healthy finance practices will help you build credit you'll need. So even if you have good credit, even 2 years out, we can always go higher. And we'll talk about credit scores for each of these home loans, or most of them. But mid 600s is really the bottom of the approval rate. So you really need your credit score 650, 640 and above. And so the higher you can get it, the lower the interest rate. So really healthy financial practices now will help you in the long run. Even if it's just a couple points, it could really help you out. So getting those collections or debt taken off of your credit, not taking out any more credits and new credit cards. Those are things that would normally lower your credit score. So if we can avoid doing those or getting the things paid off, then we're going to bump our credit score even more and more. And then it will help us in the long run. So that's 2 years out. So there's not a whole lot, I think, that there's nothing major that you need to do. It's really just being conscious about what you're spending, how you're spending, if you're using credit, being cautious about taking out more credit, but really working on that debt and that down payment is a really, really big one, because it's going to help you in the long run when you go to take out the loan. So let's move on to 1 year before you buy. So what should you be doing a year out from buying? You know that you want to buy next year. It doesn't have to be exactly 12 months, but about a year before you buy. Go and get pre-qualified from the bank. First of all, shop around for the bank that you want to utilize. Some of them will match the interest rate that you got qualified at another one. There's maybe some incentives, especially at your bank. If you bank there or have a car loan at a certain bank, sometimes you get some percentage points off. So shop around for the bank, but get pre-qualified. So pre-qualifications only last 90 days, typically 60 to 90 days. So it's not like you're going to go out and buy the home. Now you could buy a home with a pre-qualification from a bank, But the point of this a year out is really to go in there and say, if I was going to buy a house today, could I? And if I can't, I want the loan officer to tell me what are the things that I need to change on my credit report in order to be qualified successfully in maybe the price range that I want or the type of loan that I want. Most banks will not charge you a fee. It's a really quick process to get pre-qualified. You don't really have to bring paperwork to the table. You kind of just have to estimate what your salary is, kind of what your price range is, what are you looking at as far as a home. And then they'll look at interest rates and things like that. You need to know what your debt is because they will look at that. And then they will do a hard pull if you allow them to of your credit. So they will the lender will look at your credit right there in front of you and say, well, did you know you have this? Did you know you have this? You probably should work on getting this, this credit card paid down. They'll actually discuss it with you right then and there so that I have a year to work on this. I have a year to change a few things. So this also helps you understand how much home that you can afford. So maybe your expectations are to afford this much, but the lender may say at this point, you can only afford this much. And so if you want to make some changes to afford the price range that you really want, that lender is actually going to help you out to suggest how you can make some changes to do so. Like I said, they're going to pull your credit, see what changes need to be made, and give you better directions for your qualification when you come back in a year. So really it's just asking if I were to buy a house today, would I be able to, in what price range, and what are some changes I need to make in order to get where I want to go? A year out, continue saving for a down payment, and that pre-qualification is really going to be eye-opening for, down payments, but also closing costs. It's something that not a lot of people consider in the home buying process, that even though you're going to put 5% down, you may need thousands more dollars in order to do closing costs. So they're going to give you an estimate of how much you may actually need in the price range that you're looking for. So then you can continue to save. And then large deposits need to be in your account for 2 months prior to purchasing. So what this is a lot of people get randomly a lot of money and suddenly they feel like they can buy a home right then and there. And really they have to be accounted for. So if you know that you're coming into a lot of money somehow, just know that it needs to be in your account for about 2 months. So let's say inheritance, for instance. In order to be qualified for a home, that money from your inheritance, it needs to be well documented. It doesn't mean you can't buy a home right after you receive this inheritance, but large sum of monies like that tend to be, it's a lot better off if it's in your account for 2 months. If you receive a gift, so say somebody is going to help you with the down payment as a gift, that does not need to be in your account for 2 months. We just need to document where it's coming from, and there's some extra things that gifter may need to do in order to document that this money is for you and it's not a loan or anything like that. But any sort of large amounts of money do need to be in your account for 2 months prior to purchasing. So one of the things that I didn't put on this is what you shouldn't do prior to taking out a home loan. And there's a couple things that you shouldn't do that I've learned along the way. Number one is if you are in the pre-qualification process, so if you're a couple months out from purchasing your house, or you have purchased and you're just going through I forget what it's called, 30 days, 60 days out for all the paperwork, don't change jobs. Don't take out other credit cards or loans. So maybe a car loan. Once the bank has given you the green light to go buy a house and use a realtor to do so, your finances need to kind of plateau at that point. Don't make major changes to your finances when you're doing the purchasing process, because it changes everything and it changes the paperwork. So there's a lot of people that think just because I got pre-qualified and I'm looking for a home, I can quit my job, or I can go buy a new car, or I could take out a couple more credit cards. That's not the case. A year before, 2 years before, that's a little bit different. But if you're 2 months out from purchasing your home or in the process of purchasing a home, please do not make major changes to your finances. It will put a halt on the loan process, and there will be a lot more other things that you will need to do in order to follow through with that purchase. Okay, so let's go into the types of home loans that are offered. Now, these are very generalized. There's a lot more out there, but this is typically when you go to a bank, this is what they're going to offer. And we're going to go through each of these. So you'll have a conventional loan, FHA, USDA, VA, and NIFA is what they call it. So we're going to go through each of these. So conventional, this is your everyday loan. This allows home buyers, first-time home buyers, to only put down 3%, and gifts are allowed. Meaning, if I wanted to buy a home the conventional way, I can have my parents give me the money for the down payment. So that's allowed. So that 3% can be gifted to me. Also for borrowers, maybe they're not first-time home buyers, they can put down as low as 5% minimum down payment, and gifts are allowed also for that. So it's really just your typical loan. There's not a whole lot of stipulations involved in this one. 620 or higher is your middle credit score. The higher the credit score in this case, the better the interest rate that you're going to qualify for. So I had mentioned mid 600s. Some of these do allow for lower. So 620 seems to be the going, but that's going to be the lowest that your credit score can be in order to qualify for this loan. If you do have a 620, 630, something like that, you're probably going to have a higher interest rate. So the higher you can get towards that 800 mark, which is, I mean, perfect credit, but even getting into the 700s will really help you out as far as your interest rate. Conventional loans, if you only put down 3 or 5% or anything less than 20%, you will be forced to have PMI, which is private mortgage insurance. It's really just kind of it's an insurance for the liability that the bank is taking on that you're not putting 20% down. So if you are able to put 20% down, you can avoid this mortgage insurance. It could be $100, it could be $200. It really depends on your price range. It could be much more, and that's rolled into your monthly mortgage payment. If you do get PMI, it can be removed once the loan to value of your home reaches 80%, meaning you've paid off 20% of your home loan, or there's enough equity in your home loan, in your home that your loan now is under 80% of the value of the home. So if it's worth now $100,000 and you only have $80,000 mortgage, then your PMI could be dropped off. You could also pay it down a lot faster and request to have it off even sooner. So those are the main requirements for conventional home loans. Conventional, again, meaning just your typical home loan. It's not specific to any needs or anything like that. So this is just one of those main ones. So 3% for first-time home buyers, 5% for borrowers that have purchased a home, 620 credit score or higher. And then you will have that PMI if you don't put down 20%. Okay, the next one, FHA loans, 3.5% down payment is the lowest that you could put down, and gifts are allowed on this one. So you can have somebody help you out as long as it's not a loan itself. Mortgage insurance is also, so that PMI is rolled into the loan amount, and you must have a 620 or higher for the middle credit score. So again, the higher the credit score, the lower the interest rate. Excuse me. I'm gonna look at something really quick. So FHA stands for a Federal Housing Administration Insured Loan. So this is more of a federal loan. So I don't believe that there's any cap in income to receive an FHA loan, but there's just a couple more stipulations in who it's insured by. And then the USDA loan is next. I'm going to go back really quick. That's the United States Department of Agriculture Rural Development Loan. So USDA loans are really with the goal of expanding territories in a sense, or having people move into rural areas and out of the city. It's 100% financed, meaning you don't have to put anything down. except for closing costs or prepaid items. So if you wanted to live, so we're here, UBT's here in Lincoln. If you wanted to live outside of Lincoln's zip codes, then you could qualify for a USDA loan, which means you don't have to bring anything to the table. So that's really nice, and it really helps a lot of people. I do believe that there's a cap. I don't want to be held to that, but I think that there's an income cap to that. Maybe not, or else we probably would have put it on here. I apologize. Closing costs, prepaid items can be gifted or paid by the seller, meaning if you have to come to the table with, for instance, $5,000 in closing costs, you can get that gifted just like you would a down payment on another loan, or you can pay for it yourself. Mortgage insurance premium is added to the loan amount. So you will have that PMI, so that extra insurance amount that you will be paying on monthly. Yep. So maximum household income requirements. Okay. I knew it was in there somewhere. There are maximum household. So this is anyone in the household that will be living there that makes any sort of money. So your teenagers often applied to this. There's an age limit, but if your teenager's working, then they're considered household income. So it caps at a certain point. I don't know what it is here in Lincoln. It is under 100,000. Everywhere is a little bit different. So it is something that you want to look up. So if you just look up USDA loans, income cap, they'll have you look at which territory you're looking at. So that's really nice. A minimum FICO score. So your credit score needs to be at least 640. So here we go, raising the bar a little bit for that credit score. There is lower PMI and PMI for the life of the loan. So it will not come off even if you've paid off or have equity in that home. So you will have to keep that extra insurance, mainly because the loan has been financed 100%. So this is a really great loan to get. I've heard a lot of positive things if you're looking to live outside of the city. So if you are a rural person and you are looking to buy a home, the USDA loan is usually a pretty great loan to have. But your loan officer can definitely direct you in the right loan that you would qualify for and best suits your needs too. And then our next one is our VA loan. I want to make sure that it's, these are loans that are guaranteed by the Office of Veteran Affairs. So you have to be a veteran in order to qualify for this. This is guaranteed by the Office of Veteran Affairs. It's 100% financed, so nothing has to be put down. Closing costs and prepaid items can be gifted. So you do have to come to the table with closing costs, which vary depending on the loan amount and if the seller is paying any of the closing costs. And that goes down the line for any loan that you get. Funding fees are added to the loan amount. So if there are fees involved, instead of paying those up front with the closing costs, they just add it to your loan amount. And your minimum credit score needs to be 640 or more. And there is no PMI insurance on, or excuse me, PMI on this loan amount. So you don't have that extra payment of $100, $200, a couple $100 every month added to the loan. So VA loans are very specific to the client. But if you are qualified for that, it is a great option to have. Simply because of how it is guaranteed and it's 100% financed. It doesn't mean you cannot put money down either. It just means that you don't have to. And NIFA loans. These are specific loans. These are probably the most confusing to me because I'm not a loan officer. But these are conventional FHA and VA loans. There's maximum household income requirements for this specific loan. It's a first-time home buyer program. Your minimum credit score needs to be 640. And with the NIFA, an option borrower only needs to contribute a minimum of $1,000 of their own money. So it is very specific qualifications for this, and you only have to come to the table with $1,000. So if you qualify for something like this within that maximum household income, this is also a great loan to do, but there's just some qualifiers for it. So that's the main gist of the home loans and kind of what to do if you're looking to buy a home, even in the next year or two. Really just pay attention to your credit score because all of these loans have credit score requirements. And it is definitely in your favor to have a higher credit score because you're going to have a lower interest rate. So one of the things I did want to mention is if you go in for that pre-qualification at a year, um, they'll be able to look at interest rates that are happening in that time frame, but like in the present when you go in to get the pre-qualification, but there's no guarantee that those interest rates will stay for a year. So you need to be aware that your interest rate may just go up a little bit. So you need to account for that. And your loan officer will tell you that. But just know that if you do just that quick pre-qualification a year out, things may change. So it's not set in stone at what it is. Now, if you're doing a pre-qualification to purchase a home within the next 90 days, they can lock you in on that interest rate for what they're offering. So just know that as we're preparing to buy homes, things can change, prices change, prices surge at different times a year. Winter months are a really great time to buy, but there's less of an option out there because people just don't want to move during the winter. But it tends to be a good time of year to buy lower prices on houses. But in the summer, everyone's ready to go and ready to move. And there's no weather issues. And so prices may go up a little bit more. So you just have to be aware of that stuff. But a good realtor and a good mortgage lender will be able to tell you all those things when it comes time. But as you prepare, definitely seek out any questions that you have. Feel free to call me or UBT and I can get you connected with the right person to ask some good questions for. We have some really, really amazing loan officers that are very, very helpful. And they were very helpful in the making of this webinar also. Just their knowledge is good. It's very, they're very wise and they're not there to talk you into something that you can't do. They would rather set you up for success, even if it takes a couple years. So if you have any questions, feel free to reach out to me. But that is the end. So I thank you for your time today and join us on the next webinar. Thank you.